Hey traders, gold is sitting at a decision zone right now, not just technically, but fundamentally. In the first half of the video, we'll break down the 4-hour structure, the rising channel, and the key breakout and breakdown levels you need to mark. And after that, we'll zoom out and do a deep dive into the macro forces driving price. Interest rates, liquidity shifts, consumer behavior, and the core signals coming from the US economy that will decide whether gold continues the trend or retraces hard. So if you trade gold, dollar pairs, or macro-driven assets, this video is your full roadmap for next week. Let's break it down like the pros do. Gold forecast using the 4-hour structure and the latest macro signals. I'll walk you through the channel structure, the key breakout and breakdown levels, my trade plan for both directions, and the fundamental drivers that will likely push price next week. Right now, price is trading near 42.36 on the 4-hour chart and moving inside a rising parallel channel. The last two touches show price respected the lower channel support and rejected the upper channel resistance. That behavior gives us a simple roadmap. A candle close above the channel signals bullish continuation, while a candle close below the channel shifts us into bearish retrace territory. Price is also sitting inside the previous daily high and daily low range, which is acting as a short-term battleground. A breakout beyond that range combined with a 4-hour body close outside the channel increases probability for a strong directional move. On the upside, I'm watching the 4280 to 4300 supply block. A clean 4-hour or daily close above 4280, 4300, and above the channel resistance invalidates the retrace phase and opens the runway to new all-time highs. On the downside, a strong body close below the channel support and below that 4100 to 4050 demand pocket opens the door for deeper retrace into 3950, with continuation potential toward the 3800 institutional demand zone. My trade flow depends on confirmation, not prediction. If price rejects the top and pulls back into the channel mid or lower region and prints bullish price action like a pinwick, engulf, or strong rejection candle, I'll tut my shorts and flip into a long, aiming first for channel highs, then 4280, 4300, and possibly all-time highs if momentum stays strong. If gold closes below the lower trend line with a body close and breaks below 4100, I'll take shorts on confirmation targeting 3950 and 3800, with an invalidation back above the breakdown candle or a close back inside the channel. Even though gold is in a rising channel, momentum often fades near the channel top. This is why I prefer being ready to short rejections up there, then flip into long on the clean retrace into structural demand. Now, zooming out, traders, right now, the global financial system is witnessing a massive capital rotation. Reserve allocation is shifting as liquidity tightens, policy changes, and cracks are forming in the long-term carry incentive for dollar holdings. And if you're trading gold, Forex majors, or dollar-driven pairs this month, you can't ignore what's happening at the root of the US economy. Because this isn't about the charts alone. It's about the engine, the macro forces shaping currency value. The United States is still the largest reserve currency economy in the world, but currency strength isn't decided by size, it's decided by incentive. And this year, US fundamentals are showing that debt is rising faster than GDP. This means economic output is not expanding at a pace strong enough to offset fiscal pressure. US debt to GDP continues to rise as fiscal balance weakens. Meanwhile, global institutions are increasing exposure into short-term treasuries like T-bills, a signal of safety parking, not long-term confidence in yield or currency appreciation. Markets are showing a clear message. The US is trusted for stability, but not favored for long-term yield incentive right now. Now, the biggest influence, the Federal Reserve shifted stance by cutting interest rates by 25 basis points, even while inflation remains above target. On top of that, balance sheet reduction policies like QT will be paused in December, meaning the dollar will stop being absorbed from liquidity, increasing available money circulating through markets. From a currency perspective, lower rates equal lower bond yields. Lower yields equal less incentive to hold dollars for carry traders, and more liquidity equals more supply pressure on the currency's value. The real issue for the Fed isn't inflation, it's employment. because easing started while inflation is still above 2% confirms the priority flip toward protecting labor markets. Internally, the U.S. service sector is slowing, and this matters because services dominate U.S. GDP influence far more than manufacturing. Service PMI has been trending down, building permits are dropping, retail spending mix is cooling, and consumer confidence is falling. All of those reduce domestic dollar demand. We do see mild positives. Manufacturing index and new order mix are improving slightly, but in the American economy, services outweigh manufacturing in currency impact. Factories can't save a currency when consumers, services, hiring, and construction momentum are cooling. Labor indicators are softening too. Employment metrics are slowing, hiring rates are weakening, and even though labor productivity projections look forward positive, current domestic hiring weakness tells us why the Fed is concerned. Liquidity-wise, the dollar is now being treated as a funding currency, not value accumulation currency. And with risk sentiment improving in markets this week, capital isn't required to flow into dollars as a safe haven demand. It flows toward opportunity instead. So the dollar remains fundamentally pressured this week, driven by rising debt, slowing services, reduced consumer demand, falling yields, and expanding liquidity supply from easing. In this environment, gold doesn't need yield to attract capital, and its opportunity cost keeps falling as dollar returns decline. That divergence increases allocation incentive toward gold and away from carry-based currency demand. So this week, USD is structurally weak, while gold remains strong, supported by macro incentive and liquidity conditions. Traders, if you want more in-depth macro breakdowns like this before the market moves, drop a fire emoji in the comments. Tell me how you're trading dollar pairs this month. And make sure to join us here for fresh market fundamentals every week. And if you want daily gold and Forex levels, live trades, and market updates, join our Telegram channel. The link is in the description. Drop a comment. Are you long, short, or waiting for confirmation? I'll pin the best replies. Also, how's your trading going this month? We're seeing big moves across majors, so make sure you're managing your risk. Trade safe, traders. See you in the next update.